China just bought Canadian gas. Not American, Canadian. And the reason why should alarm every energy analyst in Washington. In April 2026, Canada shipped over 1 million metric tons of liquefied natural gas to Asia in a single month, a brand new record. Every single cargo went east across the Pacific. Not one cubic foot traveled south to the United States. That is not a government talking point. Reuters confirmed it, LSEG shipping data confirmed it. Real tankers, real tonnage, real history. If this story matters to you, subscribe and hit the bell right now because we track every development in this energy war daily, and you do not want to miss what is coming next. Here's the part that stops people mid-scroll. The top two destinations for that Canadian gas? South Korea and China. The same China that cut off American LNG imports after Trump's sanctions. American producers are watching their slice of the world's largest gas market disappear in real time. Chinese buyers did not wait. They pivoted. And Canada was ready. Now you might be wondering, how did Canada get ready this fast? That answer takes us to a specific location on British Columbia's Pacific coast. And once you understand the geography, you will never look at this trade war the same way again. LNG Canada, Canada's first major LNG export terminal, sits in Kitimat, British Columbia. That location was chosen with surgical precision. It sits on the shortest deep-water route from North America to Asia. A tanker leaving Kitimat reaches South Korea in roughly 18 days. The same journey from the Gulf of Mexico takes nearly twice as long. That geographic edge alone makes Canadian LNG more competitive on delivery time, on fuel costs, and on supply reliability. The plant is owned by a consortium built for one purpose: feeding Asia. Shell operates it with a 40% stake. Petronas of Malaysia holds 25%. PetroChina holds 15%. Mitsubishi holds 15%. Korea Gas Corporation holds 5%. Asia did not become a customer of LNG Canada. Asia was a founding shareholder. Stay with us because the ownership structure is only the beginning of what this facility represents, and the financial numbers underneath it will completely reframe how you see the CUSMA deadline. The plant began production in June 2025. Large energy facilities always have slow startups, sequencing, safety certifications, regulatory clearances at every stage. But April 2026 was different. For the first time, LNG Canada crossed 1 million metric tons in a single month. Every cargo went to Asia. More than half went to South Korea. One cargo sailed directly to the Dongjiaju terminal in China, arriving April 24th after a 3-week voyage from Kitimat. That single China delivery matters more than its size suggests. Since Trump imposed sanctions, China stopped importing LNG directly from the United States. American market share in the world's largest LNG-consuming nation is evaporating. Chinese buyers are not waiting for a diplomatic resolution. They are locking in alternative suppliers right now. Canada just demonstrated it can be one of them. The tanker that docked in China did not carry American gas. It carried Canadian gas. Because Canadian gas is available, reliable, and completely insulated from the volatility of American trade policy. Here is what most people do not know about the LNG business. Asian LNG prices are dramatically higher than North American prices. American natural gas trades at Henry Hub in Louisiana at around $3 per million BTU. Asian spot LNG prices are trading between $11 and $13 per million BTU. That is 3 to 4 times higher. When a cargo leaves Kitimat and arrives in Seoul or Tokyo, it is priced at Asian market rates, not American ones. Every million metric tons Canada exports to Asia generates royalties, corporate taxes, and export revenues calculated at that premium. That money flows into Alberta's Heritage Fund, into federal revenues in Ottawa, into CPP investments funding Canadian pensions, and into the wages of the workers who built and now operate the facility. The record April export was not only a volume milestone, it was a revenue milestone, and the scale of what is still coming will make April look like a warm-up. Japan's largest oil and gas company, INPEX, projects global LNG demand will grow by 75% by 2035, reaching 700 million metric tons annually. That is more than double current global production. The region driving the biggest share of that growth is the Asia-Pacific, the exact region that LNG Canada faces directly from Kitimat. The demand Canada is serving right now is not a temporary spike. It is the beginning of a structural shift measured in decades. Canada positioned itself at the entry point of that shift before the shift was obvious to anyone watching from Washington. Now connect this to the CUSMA countdown, because this record did not happen in a quiet vacuum. It happened with 56 days left before the trade deadline, while Trump's team is still demanding entry fees before negotiations even begin. Prime Minister Carney said last week that Canada will not use energy as leverage. He said those exact words, and he is right not to. He does not need to. The market is doing it for him. Every cargo that leaves Kitimat is a barrel of Canadian energy that does not need American pipeline access, American terminal capacity, or American political goodwill to reach a customer. The more Canada ships to Asia, the less it needs American approval to monetize its own resources. South Korea and Japan are not buying Canadian LNG because Canada threatened anyone. They are buying it because Canadian LNG is reliable, competitively priced, and arrives without the political chaos that American trade policy now exports everywhere it goes. The Strait of Hormuz remains fragile. Middle Eastern supply is uncertain. Canada's West Coast terminal is open, operating, and breaking records. Here is the number that should quietly alarm Washington. LNG Canada's full operational capacity is 14 million metric tons per year, approximately 1.16 million tons per month. In April, Canada shipped 1 million. The facility is already running at nearly 90% of maximum capacity, less than 1 year after production began. Now consider what is already being planned. LNG Canada Phase 2, a $33 billion expansion, has a high probability of a final investment decision this year, according to CIBC analysts. If approved, it would double the plant's output to 28 million metric tons annually. The Kassila Sims project, backed by the Nisga'a Nation in northern British Columbia, is planned at 12 million metric tons per year. Combined, Canada could be exporting over 40 million metric tons of LNG annually by the early 2030s. That estimate comes from Norton Rose Fulbright, one of the world's leading energy law firms. And then there is the story running underneath the headline, the one that the LNG record is only the surface of. For roughly a decade, the world's largest oil companies moved capital away from Canada. The oil sands were expensive. Environmental regulation was uncertain. Pipeline capacity was constrained. Shell, TotalEnergies, and ConocoPhillips sold Canadian assets and redeployed capital to the Permian Basin, the Gulf of Mexico, and projects across the Middle East. That exodus is now reversing, in a way that energy markets have rarely seen move this fast. Shell just spent $22 billion to acquire ARC Resources, one of Canada's largest natural gas producers, with assets feeding directly into LNG Canada. TotalEnergies, Equinor, ConocoPhillips, and BP are simultaneously asking investment banks to compile lists of Canadian acquisition targets. Reuters confirmed all four are doing this at the same time. That does not happen by coincidence. It happens when a market shifts fundamentally, and the early movers understand what the late movers are still calculating. Three drivers are pushing this reversal. Middle Eastern supply disruption has forced companies relying on Gulf production to reassess their geographic exposure. Trans Mountain is full, and Canada has physically proven it can move oil and gas to tidewater. The decade-long argument that Canadian infrastructure was too constrained to serve Asian markets has been answered with a record shipment. And the Carney government has signaled it wants to work with the energy industry, a policy signal that matters enormously to companies that watched projects canceled and litigated for years. There is a supply chain dimension to this story that almost never gets covered. The Montney Formation in northeastern British Columbia is one of the largest natural gas reserves in North America. It feeds LNG Canada directly. The Montney saw record drilling activity in 2025 and into 2026, driven by long-term LNG supply contracts. When Shell acquired ARC Resources, it was not simply buying a gas producer. It was buying a decades-long position in the Montney. Every well drilled there feeds Kitimat. Every cargo leaving Kitimat justifies every well drilled. The supply chain from the Montney gas fields to a dock in South Korea is now one continuous integrated operating system, and it is running. There is a financial dimension running parallel to the energy story. Last week, reports emerged that major American asset managers are circling Shell's position in LNG Canada. Shell holds 40% of the facility and has been exploring options to monetize part of that stake. The interested buyers are not energy companies. They are pension funds and infrastructure investors searching for stable, long-term cash flows. LNG Canada, with its Pacific Coast location, its Asian customer base, and its long-term supply contracts, fits exactly what institutional capital wants right now. The world's financial markets are voting on Canada's energy future. The vote is yes. And one final detail that pulls every thread of this story together. China's decision to receive a direct LNG cargo from Canada was not made in isolation. Beijing has been systematically diversifying its LNG suppliers since Trump's sanctions closed the American supply line. It has signed new long-term contracts with Australia, Qatar, and now Canada is in that conversation. The Kitimat cargo is significant because it represents North American LNG reaching China through a non-American channel. For the first time in commercial history, American producers cannot sell directly to China. A Canadian producer just did. That is not a footnote in this story. That is a new chapter in global energy trade, and it was written in April 2026. Here is the political dimension that nobody in Washington is discussing openly. Trump's signature energy pitch to American voters is energy dominance. The idea that the United States is the world's irreplaceable energy supplier and that American LNG is powering the global economy on American terms. Last month, Canada exposed the gap in that story. Canada shipped 1 million tons of LNG to Asia. China received a direct cargo specifically because Trump's sanctions closed the American supply line. South Korea, one of America's closest Pacific allies, bought more than half of Canada's record shipment. These are customers that American producers assumed would always need them first. As the November 2026 midterms approach, that data becomes a political argument that numbers make very difficult to dismiss. Canada broke an LNG export record while Trump was blocking a bridge Canada paid for, demanding entry fees for a trade relationship that already has a signed agreement, and threatening allies across 3 continents. The contrast is now measurable, documented, and attached to a concrete number: 1 million tons. Now let's talk about what this means for the people it actually affects. Kitimat is a long way from most kitchen tables, but every LNG cargo that leaves Canada's west coast is a royalty payment, a corporate tax, a job, a pension contribution. When Canada earns more from energy through higher Asian prices, through record export volumes, through new long-term supply contracts, that revenue flows into government budgets, into provincial coffers, into the CPP investments that fund retirement for millions of Canadians. The record April export makes every Canadian slightly more financially secure than the month before. The CUSMA dimension is direct. Every new export route Canada builds reduces its dependence on the American market. Less dependence means more negotiating power. More negotiating power means a better outcome for Canadian workers, Canadian farmers, and Canadian manufacturers when the July deadline arrives. The LNG record at Kitimat is not a side story to the trade war. It is one of Canada's most powerful answers to it. Before the final summary, here is what is confirmed and what is not, because precision matters. Confirmed. LNG Canada exported over 1 million metric tons in April 2026, per LSEG data reported by Reuters, a new monthly record. All volumes went to Asia. South Korea received more than half. One cargo was delivered directly to China. China has not been importing LNG directly from the United States since Trump's sanctions. LNG Canada's full capacity is 14 million metric tons annually. The plant began production in June 2025. Prime Minister Carney confirmed a new Alberta pipeline is more likely than not. Trans Mountain is full. Shell acquired ARC Resources for $22 billion in April 2026. TotalEnergies, Equinor, ConocoPhillips, and BP are all evaluating Canadian acquisition targets per Reuters. Not yet confirmed. LNG Canada Phase 2's final investment decision. A signed Alberta pipeline proponent agreement. The long-term nature of Canada-China LNG trade. The China cargo, while significant, was a single shipment. One delivery does not make a permanent supply relationship. Here is the bottom line. In April 2026, Canada shipped 1 million metric tons of natural gas to Asia for the first time in history. South Korea bought the most. China bought some, the same China that stopped buying American LNG after Trump's sanctions. The plant is running at 90% capacity less than 1 year in. A $33 billion expansion is likely. 5 of the world's largest oil companies are circling Alberta. Trans Mountain is full. A new pipeline to the Pacific is more probable than not. Trump wanted Canadian energy to flow south on American terms, through American pipelines, under American leverage. Instead, Canadian LNG is flowing west across the Pacific to markets that do not need American permission to buy it. Canada did not weaponize its energy. Canada built an exit ramp. And in April 2026, 1 million metric tons drove through it. We track every update in this story every single day. If you found this useful, share it with someone who needs to understand what is actually happening. And if you are not subscribed yet, now is the right time. Hit subscribe and the bell, because tomorrow's update is already being built.